Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So there are different techniques of financial statement analysis. The different techniques are comparative statement analysis, common size statement analysis, trend analysis, ratio analysis, funds flow analysis, cash flow analysis, analysis of variance. So many techniques are there for analyzing the financial statements. One of the important technique was ratio analysis that we have already completed in the previous videos. Nearly 10 to 15 videos I have prepared on explaining the ratios, classification, formulas, interpretation, problems, so many problems we have done. Now in this video, I am going to start the next technique. The technique is common size statement analysis. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject for accounting for management, select the videos of financial statement analysis. Watch all earlier videos, be perfect regarding what is financial statement analysis. Then only you can be able to understand this. Now in this video, completely theory, I'm going to explain you what do you mean by common size statement. Common size statement analysis, income, common size income statement, common size balance sheet. What is the importance of making this common size statement analysis? What are the advantages and disadvantages of common size statement analysis? This question, theory question, will be frequently asked in most of the examinations. So watch the video till the end, don't skip in between. Take the screenshot of the points which I have written on the board, then I'll explain all the points in detail. Now, first of all, the meaning of common size statement analysis. This is one of the technique of analyzing the financial statements. In this common size statement facilitates comparison of financial statements of not only a single firm, but also comparison of financial statement of different firms. See, the purpose of making this common size statement is not only we are analyzing the financial statement of the same company, but also we can make a comparison of different companies by making this financial statement, common size statement. So this common size statement analysis will help not only in intra-firm, but also we can make inter-firm comparison, one firm with another firm. Now, under this method, all items of statement are presented as a percentage or ratios of a particular item. How to make this common size statement? We calculate what is the percentage of every item compared to a base item. So, in the whole financial statement, we select a base item. We calculate what is the percentage of every item relating to this base item. Example, in the income statement, the most important item is sale. So we take the sale as a base item, we take the sale as 100 and express all other item as a percentage of that sale. That means this common size statement analysis will contain only percentages or ratios in relation to a base item. In case of common size income statement, all items are presented as a percentage of net revenue or sales. Now see here, there are two financial statements, income statement and balance sheet. In case of income statement or profit and loss account, the significant item is the sales or net revenue. We call it as sales or we call it as net revenue, and that will be taken as base and express all other item as a percentage of sales in case of common size income statement. Now, common size balance sheet shows each item as a percentage of total assets. In case of balance sheet, the total assets will be taken as the base and we take the total assets as 100% and express all other items as a percentage of total assets in case of common size balance sheet. Now, a common size statement helps in determining the relative efficiency and soundness of a firm. The main purpose of this common size statement analysis is it shows the efficiency of the firm and also soundness of the firm, and helps in understanding its financial strategies. So management has taken a number of financial strategies, how the financial strategies are performing, whether we are performing according to our strategy or not. This type of evaluation we can do by using this common size statement analysis. Now there are two types of common size statements, that is common size income statement and common size balance sheet. So first we study about common size income statement. So common size income statement represent percentage of each item to net revenue or net sales. In the income statement, the significant item is net revenue or net sales. That will be taken as base. Example, the net revenue is, suppose 10 lakh. 10 lakh is the net revenue. Now, in case of purchases, the purchases are 4 lakh. So 4 lakh are the purchases and 10 lakh are the sales. Now we calculate what is the percentage of purchases on sales. So 4 lakh divided by 10 lakh into 100, we'll get 40%. So simply we can say the purchases are 40% of sales revenue. Similarly, the salaries and administrative expenses are 1 lakh. So the sales are 10 lakh. Whereas salaries and other administrative expenses are 1 lakh. So what is the percentage of salary? 1 lakh divided by 10 lakh into 100, you will get 10%. Simply we can say the salaries and administrative expenses are 10% of sales. That is common size statement, income statement. So every item in the income statement will be expressed as a percentage of net revenue. Now, the comparison of common size income statement ratios indicate the importance or significance of each item in the income statement. What is the purpose of making this common size income statement? By making this common size income statement, we can be able to know what is the significance or importance of every item in the income statement. What is the importance of salary? What is the importance of rent? What is the significance of rent? How much is the percentage of rent on sales? How much is the percentage of salary on sales? In this way, we can be able to know the significance or importance of every item in the income statement, right? Now, common size balance sheet. The common size balance sheet represents the relation of each item of the balance sheet to the total assets or total liabilities. What is the percentage of every item in the balance sheet to the total assets? Example, the total assets of the balance sheet 10 lakh. Now, the current assets are, let it be 4 lakh. Current assets are 4 lakh. The total assets are 10 lakh. So what is the percentage of current assets? 4 lakh divided by 10 lakh into 140%. So simply we can say the current assets are 40% of total assets. In this way, we can express all other items as a percentage of total assets. The base is total assets. Here the base is net revenue. Now, this indicates the importance or significance of each of the item of the balance sheet to the total assets. By calculating these percentages, we can be able to know which item is important, which item is significant in the total balance sheet. In the total balance sheet, what is the importance, significance of every item to the total assets? That we can find out by making common size balance sheet. The common size balance sheet facilitates a horizontal comparison from year to year and study the trend. Every year we make this common size balance sheet, we can compare and see what are the changes, what are the variations, what is the trend in changes from one year to another year. So comparison will be facilitated by making this common size. The formula for calculating percentage of individual asset or liability is as follows. How to calculate the trend percentage or what is the percentage value? The percentage of every item. So first we take asset, then we take liability. What is the percentage of asset? take the individual asset value divided by total asset value into 100. Example, suppose the stock is 2 lakh. Stock is 2 lakh in the total assets of 10 lakh. So what is the percentage of stock? 2 lakh divided by 10 lakh into 100, 20%. So we can say 20% is the stock. Similarly, in case of liability, percentage of liability, we calculate the individual value of liability divided by total liability into 100. Example, the creditors are 1 lakh out of the total liabilities of 10 lakh. So what is the percentage? Percentage of creditors, 1 lakh divided by 10 lakh into 100, you will get 10%. So we can say the creditors are 10% of total liability. This is the formula to calculate the percentage value of asset and percentage value of liability. Now, the next topic which is frequently asked in examination is what is the importance of this common size statement analysis? So there are different points which shows the importance. First, when common size balance sheet of different periods are compared, it facilitates to determine variation and their trends. When we are making common size balance sheet of different years, first year, second year, third year, after calculating these percentages, common size balance sheet, we can make the comparison and we can be able to know what are the variations taking place, what is the trend of changes in different years. That shows the importance of this financial common size statement analysis. Secondly, when common size balance sheet are prepared for different firms in a specific industry, then it helps to evaluate relative soundness of the firm. One of the distinguishing feature of this common size statement is we can make intra-firm and inter-firm comparison. Inter-firm means one firm is compared with another firm, irrespective of the size. So we can compare two different firms to find out what are the changes, what are the differences between two firms. ABC and XYZ, two firms are there. Now ABC firm wants to find out what is the difference in our strategies compared to XYZ. So we prepare common size and can be able to see the comparison, what are the differences between our business and the competitor's business. Next, third one, common size statement analysis is more suitable when there is a huge difference in absolute increase or decrease. It is facilitated to make better decision for future. See, instead of comparing the actual values, absolute figures, we can easily compare the percentages. Many a time absolute figures will not convey much meaning until and unless we compare one figure with another figure. Simply we can say our gross profit is 5 lakh. It doesn't make any significance. It does not show any importance if I say our gross profit is 5 lakh. Until and unless this gross profit is compared with sales. So we have to calculate the ratio of gross profit to sales. It comes to 25%. This 25% will say something that every 100 rupees of sale we are getting 25 rupees gross profit. So ratios are very, very useful, and this common size statement analysis is nothing but calculating the ratios. So it helps in making comparison. Now fourth one, common size statement analysis is important in situation and comparison to be made between firms of different sizes. See here, it is difficult to compare two businesses of different size, one medium scale firm and one large scale firm. So it is difficult to directly make comparison between the medium size firm and a large scale firm, because the sizes are different, the operations are different. In that case, it will be convenient if we calculate the percentages, if we make common size statement. So if we make a common size statement of medium firm and large firm, we can compare the common size statements easily. We can come to valid conclusions by making common size statement. Last one, when common size income statement is prepared, it helps study the average individual items and their relation with revenue from operations. By making this common size income statement, we can be able to find out which item is more important, which item is comparatively significant compared to other items in the income statement. in the income statement, which expense is more, which expense is less, what is the importance of every item in the income statement, we can be able to find out by using this common size statement analysis. These points will show the importance of common size statement analysis. Now the next topic is advantages. There are many advantages of common size statement. The first advantage, in terms of percentage, the relative importance of each item is shown in common size statement. The main advantage of this common size statement analysis is it shows the individual item's importance. The individual item in income statement, the individual item in balance sheet. What is the importance of every item in the financial statement? That importance we can be able to know by making this common size. Secondly, in common size income statement, the proportion of sale is used to in cost of sales, operating expense, indirect taxes, and to ascertain by converting each item into percentage. In common size income statement, every item is calculated as a percentage of sales. So what is the percentage of cost of sales on sales? What is the percentage of interest on sales? What is the percentage of operating expenses on sales? So we can be able to analyze, dissect all the individual items in the income statement so that we can be able to control the expenses. Next one, the common size balance sheet helps in analysis to determine the percentage of total assets which is fixed and current. See here, in a balance sheet we have two types of assets, fixed assets and current assets. Liabilities, we have non-current liability, current liability. In this case, in this common size statement analysis, we can be able to find out what is the proportion of current assets, what is the proportion of fixed assets in the total assets, what is the proportion of current liability, and what is the proportion of non-current liability in the total liability. So we can be able to analyze the capital structure. We can be able to analyze what is the percentage of every item in the balance sheet. It gives an overview of capital structure, that is proportion of own capital and outsiders capital. In a business organization, the capital is contributed by the owner and as well as outsider. So by making this common size statement, we can be able to find out what is the proportion of owner fund and what is the proportion of outsider fund in the capital structure of the business. Next one, it helps in intercompany comparison, or even if firms are of different sizes. One of the biggest advantage of this common size statement analysis is, irrespective of the size of the firms, we can be able to compare the performance of one firm with another firm by comparing the common size statement of both the firms. Because we are not considering the absolute figures, we are calculating the percentages. So easily we can make comparison. Last one, both short-term and long-term financial strategies can be made using common size statement analysis. The business has to make the plans, short-term plans, long-term plans. The business has to make the strategies to be implemented for short-term and long-term. For this purpose, this is very, very important. Last one, disadvantages. Disadvantages of common size statement. Few disadvantages are also there. The first one, in this statement, relative importance of each item is shown, but there is no comparison between absolute figures. We cannot rely only on percentages. Percentages are supplementary to absolute figures. We cannot ignore completely the absolute figures and depend only on percentages. That's a drawback. We must consider both absolute figures and percentages. But common size statement will consider only percentages. That is a drawback. Secondly, time value of money is not considered. One of the biggest disadvantage in financial statement itself is time value of money is not considered. It will think that value of money will remain same from 1 year to another year. This analysis is not beneficial in making important decisions. Simply, all the decisions of the management cannot be taken on the basis of common size statement analysis. It only helps in particular situations, not in every situation. Last one is, it is not useful in segment-wise classification. Nowadays, a business has divided into different departments, different segments. So we cannot be able to analyze the segmental analysis by using this common size statement. The comparison of common size statement of 2 or more years does not exhibit significant disclosure. The policies might have changed, the business plans might have changed, but this will not be shown in the common size statement analysis. So these are few disadvantages of common size statement analysis. That's all. So in this video, I have explained you about the meaning of common size statement analysis, what is the importance, what are the advantages, what are the disadvantages. This video will be very useful for writing a theory question in examination. Very frequently they will ask. So always watch the video not once, twice, thrice. Then only you can be able to get the complete command on the concept. Inshallah, I will start the problems in the next video on this common size statement analysis.